started. So today, a few things. First, I want to mention the Bloomberg Trading Sim, which ends 2 weeks from, I think, Monday. And what you're going to need to do, just to make sure, is for this section, however many longs you had in the first half of the semester, add 10. Okay, so for example, this group, which did 45 trades in the first half of the semester, if this number is not 55, they'll get no credit. Okay, so it's not 20 trades for the semester, it's 10 trades in each half of the semester. So today, for section 301 here, yeah.
Hey, wait, no, no.
Okay. Usually Bloomberg's faster than this. Just trying to find your data.
Oh, I lost 89%. Yeah.
Yeah, it's still loading. So the point is, when it finishes loading, the number of longs, and again, I don't know why it's being so slow, but needs to be more than 10 of what you had in the first half of the semester. So just make sure that you do enough trades to not get disqualified from the competition. Yes? Shorts don't count. Longs. Minimum 10 longs each semester. Okay, so you can't just sit on cash. Let's see if it finished loading yet. Nope, still loading. Bloomberg is being so slow. This is very un-Bloomberg-like. Anyways, so you guys can go in, look at your own portfolios, and check. So moving along, I'll let it keep loading in the background. So today, we want to talk about, we have 2 lectures left this semester before your group project. So basically today and Wednesday. Okay, so next week there won't be any lectures. You're going to be working on group project number 3. And you're going to be working on your overall group projects for presentations the following week, which we'll talk about on Wednesday's class. So basically today, I want to talk about homework 9, and I want to talk about the extra credit, and then I want to talk about extra credit 3, which will be an in-class assignment that you'll work on this coming Wednesday. Okay, so that's what we're going to cover in class today. All right? So let's start out with this assignment. So if I go back to, again, I go back to homework assignments. This was extra credit 2, and in the earlier section, I'd asked just for a couple of students that had submissions for the extra credit that had companies that had similar productivity, but within 5% of each other's, and then to evaluate their EV of sales plus a third company. So one of the students that had their data had these 3 companies, Pepsi, Coke, and Sam Adams Beer for beverage companies. And on the productivities, based on the multiples, they found forward productivities of 0.66 for Coke and Pepsi. Okay, so here's the deal. Same productivity, similar wax, higher no plat margin at Coke relative to Pepsi, much higher EV to sales. Okay, so I know I just verbally said that that's what should happen. So as you went through and you did the extra credit, you should have proved time and time again that this is what happened. Because for the 2 companies, if you did the extra credit, you submitted as pairs, if they have the same productivity and they're in the same industry, they're going to have probably similar cost of capital, then the differentiator in EV to sales is going to be the margin, right? Because that's the whole point. People say that EV to sales is margin biased, okay? So higher margin, higher EV to sales. And again, it's really EV's free cash flow. So if you have the same investment, spend basically the same on building a can of soda, then the only difference to make my sales valuable is Coke gets better margins on the soda than Pepsi, therefore more EV to sales because they're reinvesting the same. So, and therefore more free cash flow per dollar. Because free cash flow is going to be profit minus reinvestment. So if I reinvest the same on $1 of sales, higher profits give me more free cash flow, therefore more EV to sales. I've been stating that for 2 weeks. You proved that in any of your submissions should have looked that way. Now what's interesting is how it was different for Sam Adams. So if you look at Sam Adams, they had very low margins, after tax 9%, compared to Coke and Pepsi, 14 and 27. However, their productivity is also much lower. They spend a lot less money to make a can of beer than Coke and Pepsi do to make a can of soda. They're spending 31 cents per dollar. They're spending 66 cents per dollar. So here's the thing. Because they reinvest less, lower margin minus less reinvestment is actually better than Pepsi. They get a better EV to sales than Pepsi. Okay? Because Pepsi, they have, and you can see this here, even with the higher WACC, 2.81 versus 2.57, because a lot lower reinvestment despite the lower margin. Okay? Now, what's going to, again, drive the EV to EBIT multiple is when we tie in growth rate. So that's the point, which is here, they get to a 30% ROIC because lower margin times better productivity. They start to catch up with Coke's ROIC, and they pass Pepsi's ROIC. So that's the point. Because they're passing Pepsi's ROIC, they're generating, ROIC is a proxy for free cash flow, more cash flow, and so therefore their sales are worth more. Okay, so that's what you should have seen time and time again. This is more of an advanced concept, but as you try and understand what's driving EV to sales, this is what's driving EV to sales. So another example, somebody did NVIDIA, was it Xilinx, or they're called an AMD. So basically in the chip industry, same thing. These two companies, very similar productivity. NVIDIA, higher margin. NVIDIA, higher EV to sales. Okay, that's what you're seeing in the industry. Now, it would be AMD, which has much worse productivity and lower margin, much lower EV to sales than either of these two companies. So again, playing out, right? And so that's what we should continue to see. Third example from today. This is Mondelez. This is GIS is, oh, PF is. Pinnacle Foods, Mondelez, GIS is General Mills. So basically, same thing. Similar productivity within 5%, 161, 162. Basically, better margin, higher EV to sales. Similar cost of capital. So again, EV, which is closer to operating value, the way Bloomberg calculates it, based on free cash flow. Free cash flow is two parts: profitability, reinvestment equals free cash flow. When the reinvestment rates are the same, therefore the productivities are the same, margin is going to determine more free cash flow, therefore more EV to sales. And that's what you should have seen. Does anybody in this class want to pull up your solution, see if you got the same type of numbers? Everybody's like, no, I don't. Do you? Okay, so let's look up yours. So this is extra credit. Assignments. Let's download. Oh, you didn't upload your spreadsheet? You just wrote it up?
No, I didn't upload the spreadsheet.
Oh, sorry, other document. Or we just look at it here. So again, similar productivity, higher margin, higher EV to sales. Applied material, don't know who Lamb Research is, and you can kind of see the difference between the two. Okay, within a 5% margin. So that's what I'm saying, is that Applied Materials is going to generate more cash flow per dollar of sales. Because like I said, with the same productivity, similar reinvestment, more gross cash flow, more free cash flow, every dollar of sales is worth more. Just repetitive. That's why I asked you to do it in that 5% band. I know it wasn't easy to find companies within the 5% band, but the reason I wanted to show you that 5% band is to illustrate this point. Okay? And that's what you're seeing here plays out in the real world. Questions? Okay, so homework 9 was on IBM. So does anybody want to share your as-is bull bear target on IBM? You want to go, right, 2 for 2 here? So let's go to homework 9. All right. Sorry, I'm chuckling at his title. IBM Disaster in the Making. I can tell this is not going to be a buy. Just guessing. All right, so let's look at the as-is. Pop down this file. And let's just focus on these 2 pages here. So, assuming you have the data in front of you, do you remember your data? Key assumptions for the, can I zoom in a little? All right. Is that big enough to see? All right, so what were your key things for your as-is?
So for my continuing value for G, while most analysts on Wall Street are going to say 2% GDP growth, I expected that 1.86 was reasonable because like IBM doesn't really have much of a competitive advantage compared to like rising powers and stock businesses like Salesforce, Oracle, and they can't really compete with like Microsoft and like Amazon.
Okay.
And like while they want to go into blockchain, that's going to take many years before that can actually produce a profit. And a tax rate 17% because like they said their tax rate is expected between 14 and 18%, and like 17 is more of a higher estimate. And after like 2020, like well they said the reason why like they went down like 8% on Wednesday was because they missed on margins and guidance was a lot lower. So I kind of knew that, like, well, it made sense that and also on Wall Street saying that even the margin is going to go down between 2018 and 2021 because they're spending a lot more on research and development and SG&A. And then I felt that like from 2021 to 2023, while their new EBITDA margin isn't going to be that much greater, we feel like there's going to be like more sales are going to be coming from like cloud computing and like as they try to go up into blockchain. But knowing that like and like when I look at my revenue growth rate, I know that the problem with IBM is that while cloud computing is one of the fastest growing industries in the world, and they're still going to struggle to try to either protect their market share or gain new market share, as like more people are going towards Google and Microsoft's putting more investment into it. So I feel like they're going to have a much harder time competing, especially when they have like limited like retained earnings that they can use to like invest in growth.
Okay, although what you're describing sounds more like the explanation for your target than your as-is. And because there's a little bit more opinion in here, not that I disagree with what you're saying, but there's a little bit more opinion. And so here's one example. Like if you look at your EV to sales divided by EV to multiple, the perpetuity margin's 18.3%, which means this row should be 18.3 and you're at 17.5. So this is what I mean by this is more of an opinion than backing into the as is, because the margins based on the trading multiple at the time last Wednesday would have suggested that this number should be about 80 basis points higher than what you have in here. So for an as is, this wouldn't be the as is that we want, because what you're then getting is lower growth, right? And just to show you an example of this, when I was working along with you guys, let's go back to IBM here. Reopen my IBM model. So if I look at my IBM model here, similar things, the key here is that this number, same thing, 18.3%, basically needs to be that number. So even though the guidance for margins is not what we expected, they are still expected to maintain this 24% EBITDA margin based on the trading stock price that was $8 lower. And so what ends up happening, and here's going to be the difference, is you got growth rates of 0.5%, which you really need growth rates closer to 4 or 5% in these out years in order to justify the current stock price. And that would be the difference. Because with lower margins, you need, lower margins and different Gs, it starts to change the way that the growth works. So in this case, I ended up with a G of 2.3% and a little bit higher growth in the out years. So that's what I'm saying is that I don't disagree with what you said, but in solving for the process of our as is, I think you were a little bit more aggressive on the lower margins and not aggressive enough on the growth rates. So that would have been the difference, right? So again, bull and bear, he's leading into the bull and the bear, right? So what he said, I would expect to be said in your presentation. So if this is 2 weeks from today and you're making your presentations, he did a good job of explaining the rationale for the assumptions. So that part was good, right? So just make sure that you do that when you go through your assumptions. So you don't just say, I think that the growth rate should be 2% and then 4% and then move on. Like he gave a good explanation for, okay, I think that they're going to be growing cloud and blockchain, but not as fast. Higher investments might, pressure your margin the next couple of years. Like all that's good, and I want you to do that. The difference, though, is he didn't follow our process for the as-is. So the as-is was more like a target, okay? And so that's where you just got to be careful of the as-is, because it's very easy to start putting your biases in there. That's why I said we're using what the academic formulas explain the models and backing out, right? And so he wasn't using that margin, so it changed a bunch of those assumptions. So just make sure that you do that when you actually implement your models. Questions? Okay. So there were 4 sections of your group project. Section 1 is EIC. Section 2 is historical analysis. Section 3 is the multiples. Section 4 is the valuation. Does the group as a whole sitting in this room feel comfortable with all 4 of those sections? Because we practiced them all multiple times. Is there anything that you want to ask about relative to any of those sections? Is there any more practice you'd like relative to any more of those sections? Yes?
I'm just wondering, what are things that feedback on the previous ones we practiced with?
Yes. Go ahead.
I was just like, about like the EIC, are we supposed to be just talking about the betas, or is there like a little more wants to talk about?
So just to be clear on the EIC, if we were doing IBM, very simplistically, so we go back to IBM as an example. So as part of the EIC, number 1, you would go to the RV section, you go to the Markets tab, and you go to the Beta tab. So you would have an industry beta and you'd have a company beta. Okay, so as part of the E, you would say that IBM is a little bit more sensitive than the average large company with a beta of 1.13, but the industry itself is at 0.9 and is a little less sensitive to changes in the economy. So for IBM, for the nature of their business, they matter more than some of their peers to sensitivity. So that'd be the first part of the E section. And you'd probably want to give some explanation as to that. Second is you would go here to custom, and you would show your operating ROIC. And so you would talk about, on an operating ROIC, how IBM does not have competitive advantage. That this is an attractive industry that borrows at 10 and makes 29. But IBM is borrowing at 9 and they're making 9. They pretty much have close to a zero spread, slightly positive. All right, so they're barely creating value on an operating basis. So that would be key to your conversation. And this is what's different. You wouldn't have used the traditional ROIC, you'd use the operating ROIC. Right? And they have tremendous lack of competitive advantage when it comes to operating ROIC compared to their peers. Okay? And so this column against this column, creating a little bit of value, no competitive advantage. Right? Because well under the industry spread. That's what you would have to show. Now, the other piece for EIC is you have to explain this. And you're going to explain this through 5 forces. So one of the areas that would help you in the 5 forces is the BICO. Industry, company. Again, don't plagiarize. You can reference. You also have the IBIS World Reports that you can reference to. Right? But notice what he said earlier when he was going through his explanation for the IBM valuation. The words that he used should have been in the EIC section if this was a group project. Okay? These shouldn't be unrelated, meaning the person doing the EIC analysis is giving the color commentary, the context that the person using the valuation should be talking about. Okay? So the challenges with their hardware business, the opportunity in the cloud, the long-term bet they're making on blockchain, that's important context that should be discussed in EIC when you're talking about the industry attractiveness and their competitive position, which he also pointed out, they're behind some of their peers in the cloud. Amazon has a much bigger lead in the cloud. They are the cloud. Microsoft has a much better cloud position than IBM. Google, technically according to Gartner Group, has better cloud technically than IBM. IBM is really struggling to be in 3rd or 4th place. And so that's the point. EIC is explaining what you're seeing here is that you see that 47% of their sales, if you go through the BICO, which I did earlier, is hardware. And hardware has been a real problem for IBM, which is one of the reasons why their sales have been declining. Because basically, hardware margins are going down, particularly as people go to the cloud. They sell servers. They sell mainframes. To some degree, they used to sell PCs. And all of those businesses are why they are shrinking. They've either been divesting them or their average selling price is getting lower and lower. So even as their cloud business is going up, half their business is hardware, and that's why IBM has shrunk. The good news is for them, the hardware business is now stabilizing, and cloud and others are now growing, and they're getting to a point where they are going to grow 3, 4, 5% in the next few years, because now that the hardware business is stabilized, that software, higher margin business is starting to help them as a mix, which is also why the margins will improve, because the cloud has much better margins than hardware. So as they shifted to the cloud, that shift in mix is why their margins are improving. It's not because of competitive position. So I'm saying a lot of what I just said should have been talked about in EIC. The people talking about the industry, the people talking about its competitive advantage should have talked about that. So it's really easy for the person doing the valuation to leverage that in the data that they are then presenting. Because now you give them the context for these numbers. To some degree, the same thing for the person who's doing the multiples. When you're explaining what those forward multiples are doing, you should be relying on what the EIC person did. That's what I mean by these are not completely disparate parts of your presentation. And so to some degree, the EIC is, I think, one of the more important parts because it's the context. Right? So if you get that right, then your explanations will be clearer and cleaner. Right? If you don't get that right, then it'll start to look disjointed. Or you'll just be giving numbers without explanation. Right? And you got to do a balance between the two. Other questions? But that's the EIC. Okay? If you go back to the EIC, that's the EIC. Questions about any of the other sections? So you're good with the historical analysis, CFI, ROIC tree? Okay, you did lots of valuations. Yes?
Should we do the reasoning for the historical analysis?
Well, again, so let's go back to IBM. So if I were to do the CFI, as an example. So again, I'm going to do it short because one, I'm coughing and having trouble talking, and two, I'm just going to be lazy today, and you're not allowed to be lazy. But basically, you have to refer to numbers when you go through the CFI. Okay. But that being said, start with the free cash flow. Again, it's your red thread. Because if it's positive, what happened to the cash flow? If it's negative, where did it come from? All right, over 5 years, we had $52 billion of free cash flow. But here's what we'll notice. The free cash flow has been declining since 2014. All right? Why has it been declining? Well, look at your gross cash flow. Gross cash flow was 20 and then 18 and then 16 and then 15 and then 10. So the gross investment was 7, outlier, 5, 4, 6, 4, 9. So it wasn't because of investment. It was because of declining gross cash flow that hurt their free cash flow. In fact, the reinvestment rate went up for IBM, but it didn't go up. Unlike we did Delta, Delta was buying more planes. IBM's investment has been pretty constant the last 3 years in terms of absolute dollars. The reason why the investment rate's going up is because their profits are going down. So they have less profits for a similar investment. That's why their reinvestment is actually going up. So it's not like they're putting more into the business. They're just putting the same in the business for the last 3 years, but they're just making less. And so it looks like they're reinvesting more. And so that's a nuance that I would have expected you to have picked up on and explained. And again, we know, based on the EIC, why this is occurring, because the profitability is declining because their hardware business is getting crushed. Right? And it's the lower margins and lower sales on hardware that is hurting their gross cash flow. And the investments are things that were just mentioned. They're making it into the cloud. They're making it into blockchain. They're making it into artificial intelligence, things like Watson. They're making those investments at a similar level, but their profits are going down. Therefore, that's what's stressing their free cash flow. That's what's increasing their reinvestment rate. So this is the linkage that I would have expected you to have made. And that's what I'm saying across all 3 sections, all 4 sections. This data in the EIC should be shared within the team, and we should have a pretty good understanding about why some of these numbers are changing. Right? Because if you read through any of the analyst stuff, it's exactly what the analysts are talking about. When are they going to return to growth? What's the growth going to be? Oh, it's these cloud and other service-based projects that they're betting on. That's where the growth come from. That's where the margin's going to come from. So that would be the future free cash flow, but the opposite is what they've been struggling with the last 3 years. When we then went to the CFI, what we noticed is the only big thing that really changed in the CFI was right here when they basically emptied the piggy bank by $4 billion in 2017. That was the big delta in CFI, right? But otherwise, they went from $52 billion of free cash flow to $56 billion of cash being paid out. The other big thing that you would have noticed is this. Their free cash flow the last 2 years is $5 billion. Their dividends are $5 billion. All of their free cash flow is going to dividends. It's really clear. So they bought back almost $8 billion worth of shares in the last 2 years. And that's why they issued this debt. They clearly issued debt to buy back the stock. Now, if I'm their CEO and I'm experiencing 5 years of sales decline, and I'm in a tech industry where I want my stock options for my employees to basically not go completely away by a plummeting stock price, I have to do something to support that stock price despite my deteriorating performance. So I'm going to buy back as many shares as I can to kill that share count. And so even though my earnings aren't growing, it's going to look like I'm manufacturing earnings in a declining environment by buying back a lot of stock, right? And I'm going to use the debt, low-cost debt, to do that. That's exactly what IBM did. And so I'm just telling you, I can tie that statement to what was being talked about in the EIC, right? Because this is not about investing in the future. And don't get me wrong, in the press release, I'm going to talk about what a wonderful future IBM has, and I'm buying back the stock because I have confidence in my business. But the reality is, this is a sinking ship, and I'm buying back a lot of stock in a business that's worsening in its financial performance with less and less free cash flow, because I have half the free cash flow that I did 5 years ago. All right, so the only way I can afford the stock buybacks is the banks are lending me the money to do that, because I don't want to cut back the dividend. I don't want to cut back my R&D in the service business in the future, and I'm trying to basically impact a stock price from falling even further. So I'm borrowing money to do so. It's really clear in the CFI. So what I'm telling you is you can do a clinical analysis of this, but knowing the context of the company, you can start tying some of the things that you know is happening in the company into the numbers that you're explaining. And that's what I'm expecting you at this point in the semester to start to be able to do. Okay? Questions? Yes, sir.
So kind of going back, I'll just look back to the EIC quickly.
Mm-hmm.
One of the sections says competitive advantage right for now in 5 years.
Yep.
What do you exactly mean for 5 years?
So what I'm saying is put your, thinking cap on and say, okay, in 2023, what do we think IBM's spread's going to be? In 2023, what do we think their margins are going to be? Do we think it's going to be about the same, or do we think it's actually going to get better? Right? Now, to some degree, you are answering this in your target valuation, because how many years are we forecasting of IBM? How many?
In ours it was
6. Every one of you is forecasting 6 years. In your target valuation, you have an ROIC in year 6.
okay.
You have a margin in year 6. You have a growth rate in year 6. This is what I mean by consistency in the sections. So when you think about what's IBM's ROIC in 6 years, is it going to be better or worse? It isn't just a random flip a coin. You actually have a forecast that you put together that's in a spreadsheet. This is what I mean by consistency in the sections, because the people that are talking about this in EIC, if they say it's not going to get any better, and the person coming up with a valuation puts up your target model and it shows it a lot better, that's what I'm going to notice. That's what I talk about consistency between the sections, because whoever's doing those forecasts, you're forecasting 6 years out. And that forecast shouldn't just be based on, oh, let's just change some numbers in the spreadsheet and make it look better. Well, that should be based on the analysis you did in your EIC. This is what I mean by it's iterative, and they should sync back together. That's a good valuation. Okay? And so that's what I mean by talking about 5 years out. And so there should be an explanation in the 5 forces context about why it's getting better. Meaning IBM's in the faster growing cloud business. Well, guess what? There's probably less power of the buyer in the cloud business than there is in the commoditized hardware business. So that's better for IBM. Even though they're competitors, Amazon is not cheap. Okay, Amazon Web Services, not like they're discounting 50% off the cost of their web versus everybody else's web. So when you think about the rivalry, the big players are not competing on price right now. They're just really competing on capacity, right? And their prices are relatively similar. Well, that benefits somebody like an IBM, because I don't have to worry about a low-cost producer coming in there and wiping me out. So is that going to change in 5 years with the rivalry? Okay, same thing as entry. How many companies are just going to pop up and build global clouds in the next 5 years? I think that there's a scale entry point to getting a secure cloud at global scale that doesn't say that we're probably going to have 4 or 5 new entrants in the next 5 years because the barriers to entry are pretty high. Now, I'm making some assumptions, and you might have a different point of view based on the research you do, but that's what I mean by tying the 5 forces to say, you know what, 5 years from now, the environment's going to probably be the same or better for the cloud. So that's going to help IBM, all things considered. And so that's why, going back to the bull bear, that's why I'm not a sell in IBM. And it has nothing to do with IBM. It has everything to do with they're in a good environment. Okay? And they're basically putting the business into a good environment, and that helps mitigate against some downside. I just don't think they're going to get the upside of some of the other companies. And that's the way that my valuation would flow out.
Okay.
You're telling stories. Make sure that the story syncs up. These were not 4 arbitrary things that I chose to make you do. These are integrated at the end of the day. Right? You should think of those as integrated. You shouldn't think of those as disparate. Other questions? These are good questions. Okay, so let's prepare ourselves for homework, or sorry, extra credit 3, the final extra credit of the semester, which we will do in class on Wednesday. So during the beginning of class, we'll work on the extra credit, and at the end of class, we will discuss it. So here's what it's going to involve, and it actually involves IBM. So let's go back to IBM's free cash flow, and let's talk about the concept of goodwill. So somebody help me understand what creates goodwill. Yeah. Okay, so how in a merger or an acquisition does goodwill actually show up?
Because you get like the value of the physical value, like the numbers of the 2 companies involved, but you also get the synergy of the companies together and having a larger market share.
Okay, so if I pay for a company, how do I figure out how much goodwill to add to my balance sheet? Anybody know? All right, let's do an example. So do it simply in Excel. Make sure we all understand this. File, new. Let's make this 200. So we're going to do a very simple company. It has assets of cash, and it's got debt and equity. So let's say it has 700 of debt or liabilities, 300 of equity, and it's got $1,000 of cash. Right? Could be a billion, million, whatever. Just rounding off, $1,000. And let's say this company decides to do an acquisition. So there are some long-term assets that we're going to acquire, and there's going to be some goodwill. So, company buys Newco for 700 and gets 200 of fixed assets. So, if I bought a company for 700, I would have 200 of long-term assets. The difference between what I paid and what I got would be the goodwill. So I would have 500 of goodwill, and I would have 300 in cash because I spent 700 to buy the other company. Nothing would change about my debt and equity. That would be my new balance sheet. Everybody with me? That's goodwill. So basically, goodwill occurs when there's an acquisition, and it's the purchase price premium. And typically, because it's a purchase price, then we can treat it as a cash flow, because whatever I just bought, I'm accounting for. That premium is cash going out the door. Even though I call it goodwill, it represents the premium in cash that I paid. Everybody with me? Okay. Now, what happens once I have the company and I want to get the goodwill to go lower? How does goodwill go down? I'm sorry? You impair it. You don't amortize it, you impair it. So 1 year later, we go to our accounting firm, Ernst & Young, say, hey, Ernst, everything's fine. And they're like, great, we'll leave the value the same. Year 2, everything's fine. leave the value the same. Year 3, hey Ernst, this didn't work out. Well, we're not getting the sales we expected. Right, we're not getting any sales. We've had all sorts of issues. So this acquisition's a bust. We're not going to get anything out of this. We're just going to write it all off. So Ernst impairs the goodwill. So let's say we convince them to write it all down. 0. There's no tax impact. It's just an impairment. We write off the goodwill. But our balance sheet has the balance. So if I, with a stroke of a pen, write 500 off my assets, because I say it's worth less than I thought, how do I get the liabilities and equity to balance? What do I do with my debt? 700 of debt. Do I reduce that? No, I do not. Because the banks are like, hey, I don't care that it didn't work out. Make it up someplace else. You still owe me 700. So you can't write off your debt. So then how do we get the balance sheet to balance? What do we do with the equity? Yep. How much does this go down to? We have negative 500 of retained earnings, therefore equity goes negative. Now our balance sheet balances. Questions? Yes?
So what is negative impact?
What does negative equity mean?
Yeah, like
So let's just say I bought a house in the district in 2006, and I paid $500,000 for it, and I got a $400,000 mortgage. 2 years later, that house is worth $300,000. I still have a $400,000 mortgage. I have a house that's worth less than my mortgage because the market has just collapsed. But I'm still making the mortgage payments. I have a negative balance sheet. I got a house that's underwater, but I'm still keeping the house despite it's underwater because I'm making the payments. The bank's not going to take it unless I stop making the payments. This company's not going to go away because it still has $300 worth of cash. So even though it's wiped out its equity, I still have some cash. I got an unhappy shareholder. They now have an asset that's worthless, right? But nonetheless, I'm not bankrupt because I still have cash. You go bankrupt when you run out of cash. Important point that he made. Questions about any of this? All right, here's the more important question. What happened to the cash? When I wrote off the 500, this went down by 500, this went down by 500. What happened to the cash? Nothing. When you impair goodwill, when goodwill goes down, it doesn't impact cash. When goodwill goes up, that's cash going out the door. Everybody with me? Understand? Anybody not understand that? You do or don't?
I don't understand.
All right, if I buy something, I had to pay for it. Cash goes out. If I write down something, there's no cash impact. That's what I'm saying. So when I take something and with a stroke of a pen, I say, you know what? This house that I bought 2 years ago is worth a whole lot less. That doesn't affect my checking account. I just have something on a piece of paper that says my house is worth less. That's a reduction of goodwill. Okay? Everybody with me? Catch up? So, let's talk about the flaw in my model. Look at IBM. Look at 2013. And look at 10, 11, and 12. Look at rows 10, 11, and 12 in 2013. What happened? $13 billion of free cash flow before goodwill. They spent $2 billion on goodwill. They had $11 billion of free cash flow. Does that make sense? If I buy somebody, does that payment for that goodwill reduce my cash flow? Okay, that's the way it should be. Look at 2014. I have $19 billion of free cash flow. I impair $1 billion of goodwill. I then have $20.5 billion of free cash flow. Does that make sense? Is that correct? You said no? Why not?
Because when you're comparing goodwill, it's not a good thing
So what am I doing here? What's my flaw?
You're adding cash.
Exactly. So there's the problem. Our model, which is just looking at a pure change in goodwill, is treating the change as goodwill as a cash flow. But the problem is, when we reduce goodwill, it's not a cash flow. When we add goodwill, it is a cash flow. So I am overstating IBM's cash flow by almost $1.4 billion because they wrote down a bad asset. So I have the wrong CFI. Does everybody see that? This is correct because they really did buy somebody. So if you bought somebody, okay, cash went out the door. I bought somebody. But here, when I just impair, it's like depreciation. It's a non-cash item. And I'm treating it like a cash flow. It's not a cash flow. There's the problem. Yes?
Does this only apply for IBM or is that for every company?
Exactly. So every time you do this, you have to go to the statement and you got to make sure that you don't have a distortion of your CFI. Now I've kept it simple to this point in the semester. And I, knowing there's flaws in the model, have not asked you to do the analysis adjusting because I needed you to get to the point where you're comfortable enough with these statements that we could talk about more advanced adjustments. But this I would call them more advanced adjustments because if you go back and you look at Delta as an example, Delta, you'll see, had some negative goodwill. And that distorted the CFI, distorted the free cash flow. So for your group project, you're going to have to identify whether your group company has negative goodwill, has a goodwill write-down. And you're going to have to manually adjust the model to take that into account. So as an example, how would I manually adjust this? What would I do? From a cash flow standpoint, what does D11 have to be? From a cash flow standpoint. 0. So what I could do, add 1395. Now, I need to get my CFI to balance. And my CFI no longer balances. So how do I balance my CFI? What adjustment would I make on the other side of the statement? Sorry? Other adjustments to equity. This is the catch-all equity account that balances the CFI. It's like equity. So here's the point. Other adjustment to equity. What do I do? Minus 1395. That is more representative of what IBM did. Does everybody see the two changes I made manually? Does everybody understand why I made those changes? Because you're going to be doing this on Wednesday, and you got to do this in 2 weeks for your group project. Yes?
So you just have to do that for every year that's negative?
Correct. So we wouldn't have to do it for 2015 or 16, but we need to do that for 2017 as well. Now, again, 2017, relative to IBM size, $300 million is not going to crush our analysis. We still should do it, but $2 billion is a lot of money. Because what we're saying is you should go look for this. You should find an extra $1.4 billion of cash that you don't see. And I'm telling you, if you're talking to IBM and you show them these numbers, they'll be like, that's not the cash that we have. So this is what I'm saying. We got to make these adjustments. Yes?
The number that you added back on
The which one?
the 13.
Well, what I did is I just added back the 1395 here to make it 0.
But what is that like?
That was, if I take out the 1395, that was the 1395 of goodwill that was impaired. So because we're subtracting this from that to get that, I just need to zero this out. Now I could just zero this out and then come over here and solve for it. That'll give me the same answer. But the point is I got to do that. Everybody with me?
What's this? So you zero out the goodwill at the top and then
I zeroed this out,
Yeah.
and then I basically balanced it by taking the same amount out of equity, the other adjustment to equity. So that was the adjustment that gets them back into balance. Because that's actually what happened. What the model did with the other adjustment to equity is when we added in this cash flow, it gave them more profits. And by giving them more profits, it added to the equity on the balance sheet to balance out the balance sheet. So what we have to do is kind of undo that by taking away the equity that was artificially added by the cash flow that didn't exist. And if this is what all we had to do, it wouldn't be more complicated. But unfortunately, I need to make it even more complicated. But before I make it even more complicated, does everybody understand where we are at this point and why we did what we're doing? Okay, so I'm going to go back in time. 1997, 1998. So I'm working with a company called Eli Lilly, makers of Prozac. Prozac is in its prime, just been discovered. It's like 80% of the company's profits. Like they're making a killing off of Prozac, first big antidepressant. Okay, so here's the thing. In 1997 was the first managed care scare. And it happened under the Clinton administration. And there was a plan put forth by the Clinton administration, led by Hillary Clinton, to basically put managed care into the U.S. Okay, and it was really the first time that we had done it, and everybody freaked out. So one of her plans that was announced was to reform the cost of prescription drugs. They were going to implement basically these prescription benefit management companies, and basically the government and a few companies would determine the price by being the middlemen to buy all the drugs from the pharmas and sell them to you and basically negotiate discounts. So today we take that for granted. It's companies like Express Scripts and Medco and others, and there's basically three of them that control about 2/3 of the market today of prescription drugs. So I don't know if you've ever gotten a prescription drug, but if you get one and you go to like Walgreens or CVS, they're going to ask for a drug card. So for example, at Maryland, this is my drug card for CVS. We just switched from Express Scripts to CVS Caremark. So I would give Walgreens or CVS my CVS Caremark drug card. CVS is the PBM, and basically they're the ones that handle all the insurance reimbursements for just prescription drugs. Okay, so if I get a drug, so for example, I got some antibiotics finally for my cough. They finally gave in after 3 weeks of coughing and gave me some antibiotics. So I paid like $4 for the antibiotics. But that was the point, because I had a drug card. I saved some money by basically going through my insurance. So what happened in 1997 for the first time is these payers were starting to be created. And more importantly, they created something called a formulary, which is basically a list of approved drugs. So, for example, the antibiotic they gave me, there's a bunch of antibiotics. So what companies like CVS Caremark will do is they'll say, we're only going to reimburse this antibiotic for this condition. Those other 4 or 5 that you can prescribe, we're just not going to reimburse. So the formulary was critical because if you were on the formulary, then your drug was approved for insurance reimbursement. If your drug was not on that list, you had to pay list price, which meant nobody was going to buy it. Nobody could prescribe it. Drugs were too expensive. And this is the first time it got introduced to the market. Everybody freaked out, particularly the pharmaceutical companies. So immediately, Merck went out and bought a company called Medco, because they said, if we're going to basically have our drugs to fight to be on the list of these few companies, we want to own one of those companies. So Merck bought Medco, and Medco was pushing Merck drugs ahead of everybody else's drugs. And then I think it was GlaxoSmithKline bought the second one, and there was a third company left at the time. It was a small company called PCS. They were based in Scottsdale, Arizona. And at the time, this is 1997, they had sales of about $300 million. They had profits of about $100 million. They had assets of about $100 million. And Eli Lilly got into a bidding war because it was a game of musical chairs, and they were the last one left. And Lilly decided they wanted to own that company because they were worried that somebody else besides Prozac could get prescribed, and they wanted to own the company to ensure Prozac's distribution. So long story short, Lilly paid $4.1 billion to buy this little company in Scottsdale, Arizona, creating how much goodwill?
39.
What's the difference between 4,100 and 100? 4 billion of goodwill. That's how goodwill is calculated. Now, from Lilly's perspective, they're buying it because they want to ensure their future. Push their drugs like everybody else is pushing their drugs. But right after they announced the acquisition, the FDA and the FTC, back when they actually had teeth, came to them and said, we don't think it's a good thing that you are pushing your drugs ahead of other drugs for business reasons as opposed to medical reasons. It could be very bad for the patients. So they made them sign a consent decree that said they will not push their drugs over competitors, and they will prove that with data month by month that they'd have to deliver to the FDA and the FTC to basically show that their drugs were not advantaged in any way. So is that a good thing to own PCS at this point? No, it's a terrible thing. So 1 year later, they decided they're actually better off not owning this, and they sold it to Rite Aid for $1.7 billion. Shortly thereafter, the CEO of Lilly retired to spend more time with his family. So, back to this. What happened to the goodwill? Okay, so I wrote off the $4 billion because I pretty much gave it to Rite Aid. I essentially impaired it. It's gone. Right? Wipe out my equity. But is there a cash flow here? Is there a cash flow coming back to Lilly? How much? $1.7 billion. There's the problem. I wrote off the goodwill, but I sold the asset and got something back. I just didn't impair it. In our little mixed metaphor IBM example, what did we do with all their goodwill? What did we do with the $13.95? Just a minute ago. What did we do with the $13.95? We said it was not a cash flow, we wrote it down. But what if IBM sold a business for less than it paid? What if it did a PCS? Do we have the right cash flow? No. There's the problem. That's why I said this is advanced. And there's no easy solution to this one. Because we have to try and guess how much cash they got that netted the downgrade of the goodwill. Because I sold some businesses for less than I paid, but if I didn't just impair it, if I got some cash flow, well, I got to treat that cash flow as cash coming in, and I can't just ignore that. So here's how we're going to attempt to get closer to this number. Let's go back to Bloomberg. FA. Cash flow statement. Scroll down. What's this line say? This was the year we're talking about. So how much is that? $23.57. So what does that mean? What does the $23.57 tell you? What does cash from divestitures mean? You guys are accountants. This is an accounting statement.
Is it from selling off parts of your business? Like
That's right. It's how much cash they got for selling off parts of their business. $2,357,000,000. Then, here's the thing. How much goodwill did we write down? So we wrote down $1,395,000, but how much cash did we get from divestitures? $2.3 billion. So basically, we did get about $1 billion worth of cash out of this. Does everybody see that? So it's not perfect, and I'll tell you why in just a second. So here's what I would do. I would add the $13.95, and then I'd subtract the $23.57. So they actually did get about $2.3 billion worth of cash from selling off assets as a one-time sale. Does that make sense? Except the real free cash flow is probably this number, because this is one time. So to get my statement to balance, I put in the 2357. And then I'd adjust this by 2357. Now, here's the thing. This is not perfect because, like I said, we now have a one-time sale. We can't really call that operating, right? So that's what makes this tricky. So your real free cash flow is going to be the number above. It's going to be the free cash flow before goodwill, in this case. That's the number you would use for your analytics that year. Because otherwise, the sale of assets, you don't sell assets again and again and again. It's a one-time thing. But to get my statement to balance, this is what I would have to do. Now, here's still what's problematic of what we just did, which is, what if we disposed of a business that didn't have any goodwill? So there's becomes the problem, is that I wrote down the goodwill, but then I have a disposal of assets. What if I didn't acquire that from somebody? What if I just built a business and I just sold it off? There's no goodwill associated with that. So that's the problem. It's hard as an outsider to figure this one out, right? Because we can't just say all the goodwill was associated with just this business, because maybe it wasn't. Maybe it was associated with one business but not another business. And what we're doing is we're kind of allocating across all the businesses that they sold. Right? So it's not perfect, but at least it gets us a balancing statement, and it's less likely to distort the cash flow. So here's the point. What do we analyze? This, 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 this. That's what you're analyzing. It changes because we don't want to put in one-time items, but we're making the one-time item in here so it doesn't screw up our cash flow and it keeps our statements in balance, so we have to make those adjustments on both sides. I don't know how to automate this. I really can't. But nonetheless, this is something we have to deal with. And you're going to deal with this twice. You're going to deal with this on Wednesday for an in-class example that you're going to work on, and you're going to have to deal with this for your group project. Because if 60% of you don't have negative goodwill, this is not an issue for you. But if some of your groups do have negative goodwill, this is an issue for you. And you're going to have to deal with this. And you're going to have to basically take out the impacts and change how you do your analytics for the years when you make these adjustments. Questions? Yes?
So when we added we subtracted the 2357 from the goodwill, and we subtracted again from this year from the other adjustments?
Yeah, so here,
Or add it back, add it back.
what is it, 2357? Nope. Sorry, other way. Add it back.
Okay.
Anyways, the point is, we get it to balance by using the equity as a plug. That's the short answer. And it's actually going to be the delta. But as I said, you'll solve for it, and you'll just basically make the balance sheet balance, or the CFI balance, by solving for it. Okay? Because it's going to basically be the billion twice. It's going to be the difference between that and the goodwill twice. That's what you're going to actually put in there. Yep.
So basically, like, when it's negative, we're using a free cash flow, excluding goodwill. When it's positive,
Yeah, because when it's negative, the whole point of free cash flow is I'm using that asset as an operating part of my business. When Lilly bought PCS, they're actually using the PBM to sell more drugs. It's operating. When Lilly sold PCS, it's a one-time sale that's non-recurring, and I don't put non-recurring things into my operating bucket, so it immediately moves to the non-operating bucket. So that's the point. I get my free cash flow after goodwill to balance, but the drop in goodwill is not part of operations, therefore free cash flow before goodwill. Because that is more representative of the business after the sale. Yes?
So on the presentation, do we really need to mention how we adjust the goodwill?
You'll have to mention that you did adjust it for a particular year. Just so that I know that you adjusted it.
Because my company has like 4 years straight have negative.
Then you're going to have to adjust it 4 years. So I'm just telling you, now you really want to get fancy? If you listen to the words that I said, and that's why I'm trying not to overcomplicate it too much at the end of the semester. But what you really should do is you should zero this out, and you should make the adjustment in the non-operating section. Like it should be here as a non-operating asset adjustment. That's actually where you should make the adjustment, not in goodwill. Okay? But regardless, I'll let you make it here just because it's simple. So this 2357, because once I sell it, it's one time. Once it's one time, it moves out of the operating, so it's not part of free cash flow at all. So what I'm saying is, I'll let you make it in the free cash flow for simplicity, but that's why you have to know that for your company, you're pretty much going to be analyzing this line. Except for the 1 year when they actually did buy things that they used. Because that's the whole point, is I just want to know what's really operating about their business. It's more complicated, it's more advanced. These are some of the nuances you got to get into. So I'm trying to simplify the complexity, to at least make you aware of this, because for her reason, whatever company she's analyzing, it's going to be completely distorted with all these negative goodwills. And it will make it look like they're generating a lot more cash flow than they actually are. That's why we have to make these adjustments. Okay, so on Wednesday, we're going to go through a company. You'll have a chance to practice this. You'll work on it during class. You'll submit it. At the end of class, we'll talk about it. That's going to be extra credit 3. So we'll see everybody on Wednesday. Yes. And I just recorded this if it matters, but I will be choosing the company on Wednesday.